Hello, in this video we are going to see monetary policy when price level is constant intuitively. We are going to see that if central bank increases money supply, then the economy goes from this point to this point. This is what we are going to see. We have already seen with the simulator and analytically that the economy goes from here to here and from here to here when central bank buys bonds. Now we are going to see exactly the same but intuitively. Okay, so when central bank buys bond, then nominal money supply increases, but because we are assuming that price level is constant, then real money supply will increase as well. So this vertical red line, which is real money supplies, will shift from this position to this position. So real money supply increases. This is quite intuitive. Now, what about liquidity? Well, liquidity will increase as well, because if real money supply increases, there will be more real money in the economy, so people will want to do more transactions, and then in order to make transactions they will need more cash. So that's why intuitively liquidity goes up. Now, why the economy goes from this point to this point intuitively? This is what we are going to see now when central bank buys bond. Well, when central bank, or if we are in the United States, Fed buys bond, what happens is that the central bank is a buyer of bonds, therefore the demand for bonds increases. So when the demand for bond increases, then the price of bonds increases as well. And then if we transfer this increase of the price of bonds here, we pass from this point to this point in which the interest decreases. If we want to see this analytically, then you pass from 80 to 85, you plug 85 here, and then you will see that price goes up, and then up, up, and up, and therefore 100 minus something that went up, the difference goes down. And then if this goes down and this goes up, then this division goes down. Therefore interest has to go down, which is what we see graphically. Now, if Fed buy bonds and interest go down, then the economy pass from this point to this point, because here we have interest in the vertical axis. And now what happens when interest goes down? Well, the goods and services market wake up, and then the farmer, or in general firms, see that interest is low, so loans are going to be cheap, and then they will increase investment. And investment, because interest is low, they can increase investment. And investment is part of aggregate expenditure that in equilibrium is equal to income. So income increases as well. Therefore, in the horizontal axis, because income increases, then the goods and services market pull increasing income. So the economy passes from this point to this point. Now, if Fed goes on buying bonds, then again demand goes up, prices goes up, then the economy passes from this point to this point, and then interest rates goes down, and therefore central bank pull in that direction, goods and services market wake up and pull in that direction, and then we repeat the process, and then interest will go down again, and therefore income will go up again. So we pass from this point to this point. Okay, but in this model the central bank is supposed to buy all of the bonds at the beginning, so in this point. So we don't know exactly how the economy will go from this point to this point, but what we know is that because Fed buy bonds, the interest will go down, and because of this, investment and therefore income will go up. So how we know that we are going to end up in this point? Because this is the unique point in which the good and services market represented by the AES curve and the new LM curve, which represent the money market, is in equilibrium. So in this point is the unique point in which both markets are in equilibrium. Okay, that's it. See you in the next video, and thanks for watching.